What if I told you that a single product's launch could make an entire massive industry feel obsolete literally overnight? Well, in early 2026, that is exactly what happened to the world of software. This is the story of how one announcement changed absolutely everything.
Software stocks have become ground zero for investors' anxiety over the possible disruption coming from AI. The software sector as a whole has lost about 30% of its value in just the last 3 months, with those losses accelerating this week, even despite some relatively strong earnings from leaders such as Salesforce.com, such as Microsoft. Now,
$300 billion. That's how much value is just wiped away from the software industry in a matter of days. And look, we're not talking about a slow decline here. This was a shockwave, a sudden, violent repricing of an entire sector. The crazy part? It wasn't a market crash or a recession. It was a single piece of software. You see, for years, we all thought of AI as a feature, right? It was a cool tool that made the software we already used a little bit better. But this event, it forced investors to confront a new and, frankly, terrifying question. What happens when the AI stops being the tool you use and starts being the coworker that does the job for you? So the company at the very center of this storm is Anthropic, and the product they unleashed was called Claude Cowork. This wasn't just another app or a minor update. No, this was a fundamental shift in what AI could actually do inside a business. And it all went down at an incredible speed. I mean, just look at this timeline. In the last week of January alone, Anthropic updates its safety rules, then gets slapped with a multi-billion-dollar lawsuit from the music industry. And then, just 2 days later, they launched the very product that kicks off what everyone started calling the SaaSpocalypse. What a week. Okay, so here's the core idea you have to understand. For decades, software, or SaaS, gave you a dashboard. You logged in, you clicked buttons, you filled out forms to get your job done. But this agentic AI, like Claude Cowork, it flips that entire script. You just tell it the goal, hey, update this customer in Salesforce, and the AI goes and does it for you. It's the difference between driving the car yourself and just telling your chauffeur where to go.
Talk us through this new model that was released by Anthropic. Why did it cause so much disruption yesterday?
Yeah, hi, Joanna. Yeah, I mean, you could argue that Anthropic's having a bit of a DeepSeek moment, if you remember.
This wasn't just a demo. It launched with 11 plugins that were ready to automate entire professional jobs right out of the gate. We're talking about it acting as a paralegal, a financial analyst, a data scientist, you name it. The sheer breadth of its skills was just staggering. This was not another chatbot. This was an entire digital workforce in a box. So how in the world did one product cause a $300 billion panic? Well, it's because it basically exposed 4 deep, dark fears that were already bubbling just under the surface of the entire software industry. First up, the moat around these companies is disappearing. For years, a company's unique proprietary code was like a castle wall. It was their big competitive advantage. But now, we've got AI that can write, debug, and deploy code so cheaply that a tiny startup can copy features that used to take huge teams years to build. That wall is crumbling, fast. Second, and this one is the real killer, is disintermediation. Think about it. If an AI agent can update Salesforce for you, why do you need to pay for so many people to have a license, a seat, for Salesforce? The AI is cutting out the middleman, and in this case, the middleman is the software app itself. This is a direct attack on the business model that built the entire industry. Third, their profits are getting squeezed. And here's the bitter irony. To even try to compete with this new AI, every single software company has to build its own AI features. But running these things is incredibly expensive. It takes a ton of computing power, a ton of those NVIDIA chips. So their costs are skyrocketing, but they can't really charge customers more. Their profit margins are just getting crushed. And finally, all of this leads back to Wall Street. Investors used to pay a huge premium for software stocks. Why? Because that subscription revenue was seen as predictable and sticky. But now there's a very real risk that your customers could just ditch you for a cheaper all-in-one AI agent. That predictability is gone. The risk is way higher, so the price investors are willing to pay is way, way lower. So you put those 4 forces together, and here's what you get. A massive consolidation of power and value. The money is literally flowing away from all those specialized software apps we use, and it's getting captured by the layers above and below, the big AI models like Claude, and the infrastructure guys like NVIDIA, who sell all the chips. Now, a crisis of confidence this big doesn't just stay in Silicon Valley. Oh no, it spread. And it spread fast, right to the financial giants who had bet billions and billions of dollars on the idea that software was a safe bet for decades to come. And the immediate fallout was just brutal. And look, these aren't some volatile tech startups. These are the titans of private equity. Blue Owl Capital, a firm that specialized in software financing, got hammered, down 13%. ARES, Blackstone, these are the biggest names in the game. And they saw huge drops as investors woke up and realized just how much money was tied up in this suddenly very vulnerable industry. And they were so exposed because today, something like 20%, 1/5 of all investments held by these key investment vehicles called business development companies are in software. That concentration has doubled since 2016. It created this huge systemic risk that the market had pretty much just ignored, until now. And get this, in the enormous $1.7 trillion private credit market, a staggering $440 billion of it is debt that was used to finance software company takeovers. That's almost $500 billion in loans, all backed by companies whose core business models were just put on life support. So, with their old playbook basically shredded, the smartest investors in the world are being forced to adapt, and they are adapting fast. And what they're doing now tells us exactly where they think the future of technology is really going. I mean, just listen to this quote. This is from Mark Rowan, the CEO of Apollo, one of the most powerful investment firms on the planet. He's asking out loud, is software dead? The fact that a leader of his stature is even asking that question publicly, it tells you how deep and how fundamental this shift really is. And they are not just talking, they are moving their money. Blackstone and Apollo are both backing away from direct software investments. Apollo cut its exposure by almost half. So where's the money going instead? They're investing in the picks and shovels. They're betting on the physical stuff that powers AI, things like massive data centers and the power grids to run them, instead of the applications themselves.
So, the real takeaway here is this. The era where you could just assume every software company was a golden goose, that is definitively over. The value is migrating. It's moving away from the apps on our screens and consolidating in the huge foundational AI models and the physical infrastructure that makes it all possible.
The SaaS apocalypse showed us just how quickly the ground can crack underneath an entire industry because of this new wave of AI. But software was just the first domino. The real question we have to ask ourselves now is, what industry is next?